Most traders don't lose because their strategy's bad. They lose because they trade too big. Here's why smaller trades quietly outperform big ones. Trading big feels like confidence, like you're making a bold statement in the market. In reality, it destroys the three pillars of success: consistency, discipline, and sheer survival. This is about why professional traders size small and how you can use the same logic to finally become profitable. The core rule, the one thing you need to burn into your brain is this: you don't get paid for being right. You get paid for staying in the game. Let's start with reason number one. Small trades protect you from drawdown. Here's a reality check. Big positions don't just amplify gains, they amplify losses, and the math on recovery is brutal. Drawdowns compound much faster than your gains ever will. Let's look at the numbers. If you lose 50% of your account, you need 100% gain just to get back to where you started. 100%. But if you lose only 10%, you just need an 11% gain to recover. That gap is the difference between a minor setback and a career-ending blow. The action here is simple. Risk a fixed 1 to 2% of your capital per trade. That's it. Always remember, survival math beats ego math every single time. Reason number two, small size keeps your brain rational. Big trades are an open invitation for your worst emotional instincts to take over the keyboard. They trigger primal fear and greed. That fear makes you exit winning trades way too early, leaving huge profits on the table. And when you take a big loss, the anger leads directly to revenge trading, doubling down, breaking rules, and digging an even deeper hole. Small trades, on the other hand, keep those emotions manageable. When a single loss won't hurt you, you can stick to your plan. You can execute based on your rules, not your adrenaline. The smaller the size, the clearer the thinking. If this is already sounding more realistic than all the get-rich trading content out there, subscribe. This channel is about making trading sustainable, not just exciting. Now for reason number three, small trades improve your execution quality. When a huge amount of money is on the line, what do? You hesitate, you second guess, you wait for that perfect confirmation that never comes, and you miss your entry. Or you slam the market with a huge order and get hit with terrible slippage, costing you money before the trade even has a chance to work. Small trades remove that pressure. They allow for better timing and a full, clean execution of your strategy. You're focused on running the play correctly, not on the outcome of a single trade. Remember, precision completely disappears when your size is too large. This leads to reason four. Small size lets you compound consistently. Here's the truth about building wealth in the market. Consistency compounds, but volatility destroys compounding. Getting a steady 1% gain every day is infinitely more powerful than landing a few sporadic massive wins followed by devastating losses. Those big swings kill your equity curve and your confidence. The goal isn't to hit a jackpot, it's to focus on your strategy's positive expectancy over hundreds of trades. True wealth in this game comes from repetition, not from spikes. Reason 5. Small trading reduces the account killers. There are a few key behaviors that are guaranteed to blow up your account: overconfidence after a win streak, going on tilt after a loss, and misusing margin to place trades you can't afford. Trading big pours gasoline on all of these fires. A big win makes you feel invincible. A big loss sends you into an emotional spiral. Small position sizing is the built-in circuit breaker. It prevents those emotional spirals and stops you from having that one catastrophic day that wipes you out. Most traders don't fail from many small losses. They fail from one bad day. And that brings us to reason 6. Professionals scale after proof, not on hope. Here's what the pros do. They trade small to prove a strategy works. They track the results meticulously. Then, and only then, do they scale up slowly, incrementally. Amateurs do the exact opposite. They size up early, hoping for a big win. They chase their losses by adding to a bad position. They completely skip the data tracking phase. The action is to only increase your size after you have hard proof of consistency. Size is earned, not chosen. So what does trading small actually mean in practice? It means you risk a fixed percentage of your account on every single trade, usually 1 to 2%. It means there is no emotional sizing.
You don't trade bigger because you feel confident, and you don't trade smaller because you're scared. It's the same size, same risk every single time, according to your plan. Before you enter any trade, you run a checklist. Is the setup valid? Is my risk defined with a stop loss? And is the potential loss psychologically acceptable to me? Here's the ultimate test. If you're nervous the second you enter a trade, you're trading too big. Now let's talk about the biggest trading lie ever told. People think that trading bigger speeds up success. It doesn't. It speeds up failure. So, here's your 30-second action plan starting right now. First, cut your current trade size in half. Second, fix your risk to 1% per trade and don't deviate. Third, track your results for the next 30 trades without changing anything. Fourth, only scale up after you have proof that your process works. Small trades build big accounts. Let's be clear, trading small isn't playing scared, it's playing to win over the long haul. If you can survive your drawdowns, if you can control your emotions, and if you can execute your strategy consistently, the profits will follow, quietly, predictably, and sustainably.